Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. Investors are looking in the wrong direction. We've had the largest correction on the S&P 500 since the COVID-19 crash, and I think we're set to see some pretty wild moves in the next few months. Very exciting times ahead. Now, if you want to follow these crazy markets with us, make sure to click on that subscribe button. We make these videos multiple times a week, covering our research and our personal convictions on what is going on the equity markets, what's going on with the economy, and how you can protect yourself and potentially, hopefully, profit from everything that's happening. Now, without further ado, let's get right into it. All right, so the first chart that I want to show you guys is, first of all, the put-call ratio. This is a classic. We take a look at this all the time on this channel. It gives you a measure of the sentiment, especially the short-term trading sentiment, right? How heavily positioned are traders for the market to go down or for the market to go up? If there's too many calls in the market, so this ratio is extremely low, that's when you should be booking profits on your S&P 500 gains. But when there's lots of puts, meaning a lot of people are betting for the markets to go down, that's when you should be buying the dip. So no indicator should be used alone, and our convictions are based on a lot of different factors, but this is definitely one of our all-time favorite indicators, right? Just how successful it's been at timing market bottoms. Let me quickly show you the S&P 500 on top of this chart. This was the COVID panic. Huge spike in puts, and look at this, it spikes up at the market bottom right here. And then all spikes that came after that were moments to be buying the S&P 500 and not panic like most people are doing right now, expecting some kind of massive bear market right now. We're going to take a look at more data in just a second, but this is not telling me to panic. It's telling me to look in the opposite direction from the herd. Now, speaking of the herd, let's quickly take a look at this. This is the AAII Bulls survey, right? This is, again, another huge measure of sentiment. It's one of the oldest surveys of sentiment, so that's great. We have a lot of data that goes back a very long time ago. And they basically ask investors, or at least the AAII pool of investors, whether they're bullish on the stock market over the next 6 months or not. And so here you can see the number of bulls there are in the market. And ever since March 2021, we've had the sentiment absolutely drop like a stone. In fact, here, look at this reading here. We are currently at 19.2% of investors bullish on stocks. So there's less than 1 in 5 investors that are bullish on the stock market right now. Everyone's waiting on the sidelines. Everyone's paying attention to what the Fed is doing and the hawkish concerns over inflation. Now, don't get me wrong, right? There are some legitimate concerns behind this, but when everyone's looking at the same thing, look in the opposite direction. In fact, I wanted to take it a step further, so I back-tested this indicator to actually go back and see how many times we've had this type of reading, meaning we actually have under 20% of investors that are bullish on the stock market. And you can see over the last 20 years of stock market data, we've had this reading 5 times, not including this one. And every time it gave absolutely massive returns over the next year, over the next few months. We had the same reading in 2005. At the very bottom of the 2008 financial crisis, right before a 12-year bull run. In 2013, right here, at the bottom of this 2015 correction here, we had a sideways period of consolidation on the stock market. You had that reading at the bottom of it. And we have the same reading now. Now think about how sentiment works. If everyone's scared, everyone has cash on the sidelines, then that means there's a lot of buying power to take this higher. It's a lot more likely to go up and not make a big top. So those are 2 ways of looking at sentiment: put-call ratio and the AAII survey. Both of them are telling us that we should look the other way. Okay, so now you're probably wondering, that's all very nice, sentiment is useful, right? But what's actually going to push the price of the S&P 500 higher. What happened here? What caused this panic that's all of a sudden not going to be a question anymore in the next few weeks or next few months? And if you've been watching our videos, you'll know that a large part of what caused this correction was the rising yields. We've had the 10-year yield rise exponentially, and we've had the 2-year yield rise exponentially. Now, we've talked about this many times in our videos, and this is what's causing some market volatility. It's absolutely 100% to be expected, because as yields rise, that puts pressure on the tech sector, and the tech sector has just been tanking ever since November, ever since this bottom in yields here, and we've had this massive rally in the 10-year yield. We've seen tech just absolutely tank. This is a chart of the tech sector's performance, and you can see that's exactly what's happened here. We've had tech just absolutely tank with this rise in the 10-year yield. But now look at what we're starting to get here. We're starting to see a nice little bearish technical setup with a lot of divergence between the price and the RSI, right? We have yields making higher highs. In fact, we have one final higher high here and momentum just dropping like a stone, telling us that perhaps this move that we've had is coming to an end now, and we should be looking for a correction. So what does that actually mean? That means we're going to see bonds rally because bond prices and bond yields are inversely proportionate. So we can finally expect TLT to rally here. I think there's going to be a couple of fellow YouTubers that are going to be very happy about that, although I don't think that's going to last very long. And we're going to see technology recover massively, bringing the US stock market higher with it. Now, of course, those are just our convictions. In fact, this is where I wanted to take a look at this fund manager survey from Bank of America. Now, we usually don't take a look at what the banks have to say. They often try to mislead the average investor into making poor decisions. But their fund manager survey is extremely useful to actually know how funds are positioned. And you can see this is just absolutely fascinating how funds are currently positioned in the exact opposite way as our convictions. They're currently very overweight in the banking sector, which means they expect yields to rise because banks perform well when yields are rising. They're heavily positioned in cash, meaning that they expect the stock market to drop and for there to be better buying opportunities. And they're underpositioned, underweight in bonds, US equities, and tech. And those are the three things that we expect to rally very hard in the next few weeks. Now, why am I saying this? And why do I sound so happy about it? Because if funds are overweight in cash, that means there's a lot of cash on the sidelines waiting to buy what they're currently underweight in. And that's bonds, that's US equities, and tech. So I think funds are going to be selling the banks to buy tech and to buy bonds to rebalance their portfolio. Now, if you're glad that you're watching this video and it's helping you put all of this data, all of this information into perspective and hopefully adding to your knowledge, adding to your experience in this beautiful financial education journey that we're all going through, make sure to smash the like button as hard as you can. It is really appreciated, all the effort, all the time that goes into making these videos and actually giving you guys solid, objective convictions. That's all for the price of just a couple of seconds to hit that gray thumb. Now, don't get me wrong, I don't think we're going to see yields drop down to zero straight away. We're still heading towards monetary tightening. There's still inflation, and the Fed hasn't tackled that problem yet. They haven't tackled inflation. And as long as that's the case, we can continue yields trending up. But there's going to be a counter trend correction here. At least that's what we think. And we've positioned accordingly. In fact, we have a series of trades on our trading watch list that are beginning to play out beautifully. And I think that's going to continue being the case for the next few weeks. We're currently seeing gold break out here. We recently posted this video on gold, on the longer term picture for gold and how investors should be looking at their allocation to gold. We're getting some pretty big green candles on gold, which is nice to see. We had multiple posts throughout the last year where we highlighted accumulation opportunities for gold. Crude oil is another one of those trades that is playing out beautifully right now. I'm really liking what I see on the charts here. We had a nice, beautiful false breakout here. This is a price channel that has multiple reactions along the way. And right here on the 14th of February, right here as we had that breakout, we called it out and said this was going to be a false breakout, and it seems to be playing out right now. We have momentum shifting to the downside. Obviously, we're going to be making regular updates as the trade plays out, or if it goes the wrong way, we'll of course be updating that as well. But if this plays out beautifully, then this is going to be the third time that we short crude oil successfully. We traded all three of these big dips on crude oil. Now, what do I mean by adding a trade to the watch list? This is not easy money. We're not telling you exactly what to do with your money. It means we find that setup particularly interesting, and we're going to be increasing the frequency and the detail of the research that we make on that setup as long as we find it interesting. You still have to do the work yourself. You still have to do your own research. But the aim of the service is to spot the opportunities that we find attractive and then give you detailed, high quality data research and analysis on those setups. If you're interested in that service, make sure to click on the link in the description below. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to click on that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.